Ron Cohen, target date funds have certainly grown in popularity as more people want to set it and forget it. But is that for everybody?
I think that the target date funds have a place, right? There's those participants that just don't know where to allocate their monies, and they don't want to have to allocate their monies. And the target date funds work very well. However, that set it and forget it mentality that started target date funds back in the 90s and early 2000s has really started to creep up on people and realize that that might not be the best way. There needs to be an active component to it. And so what you've seen are more and more target date funds doing tactical asset allocation, right? So they're adjusting things at the fringes. If they feel equities are better to be in, they're going to go a little bit higher in equities. If fixed income is in favor, they can tweak the portfolio a bit that way. So yes, it is right for a good number of the participants out there. It's a great way for someone who doesn't know where to invest to put their money. But again, that set it and forget it mentality is something we need to start to get away from.
Well, in a target date fund, you want to be aggressive early and conservative as you approach retirement. How aggressive should people be?
Yeah, that's the big question, right? That's the conundrum that you face because we did a lot of research on this. And what you find is you really need to remain as heavy in equities as possible, as late as possible. But the challenge that you face is as you get closer to retirement, you want to go and pull back and be more conservative. So what do? You can't be aggressive and conservative at the same time. So what you're starting to see are mutual fund companies and target date providers utilizing more sophisticated tools where they can actually stay invested in equities later on in life, but be able to have risk tools in place to make sure you're protecting those participants.
Well, right now the big worry is about bonds because with rates on the rise, there's a big worry that there's going to be a massive exit through a very slim door to get out of your bond positions.
Right.
So talk about the flexibility of target date funds so people really don't get hammered on the bond side.
Yeah, so there is flexibility, but it's limited. Okay, so the target date funds have a set glide path, and that's what they're out there promoting and talking about how they're adjusting as people get closer to retirement. So there are bands that they have to remain within. So within fixed income, there is a certain band that they're going to have to stay within as dictated by their prospectus. We talked about tactical asset allocation. They can make some adjustments at the fringes, but what you're starting to see are the more sophisticated target date providers utilizing alternatives. Right? An alternative as a way, as a hedge against the fixed income, right? So whether that's REITs, whether it's TIPS, whether it's an infrastructure product, something to help give that protection as we start to see what happens with interest rates.
So how should an investor shop for a target date fund? What's the best way to compare Wells Fargo's versus T. Rowe Price's versus anybody else's?
Yeah, I think the first thing you need to think about is what's your demographic, right? What's your participant base look like and what's most important to them? Are you looking for something that's more aggressive because you have an aggressive participant base or a young participant base, or is it a more senior participant base and you need something more conservative? So it's aggressive versus conservative, which glide path makes the most sense. Then you're starting to look at things like expenses and performance. But really are you comfortable with the manager's approach and what they're going to do for your participants and really see if they can get them to that 80% income replacement come retirement.
And then finally, Wells Fargo, your firm is rolling out brand new dynamic target date funds on December 1st. What makes them so dynamic?
So the dynamic component is based on three things, right? So we talked about tactical asset allocation. So we have that piece. But we also layered in two other risk tools. One's a volatility management tool and one's a tail risk management tool. So the volatility risk tool is something that's looked at on a daily basis. And based on the long-term average of the volatility of the underlying portfolios, the fund can then buy or sell S&P futures to either increase the equity exposure when volatility is low or to decrease the equity exposure when volatility is high. So really what you're doing is you're smoothing out the ride for the participant. The tail risk management is the critical part in case that we see a huge drop in the market. If 2008 happens again, the fund has the ability to actually hedge the entire portfolio and create a basket of futures that mirrors that portfolio but hedges it and protects the participant as they get closer to retirement.
All right. Well, thanks a lot, Ron.
Greg, thank you. Really appreciate the time.
And thank you for watching The Street.